Okay, so next up, we've got this convergence, tokenization, blockchain, artificial intelligence, agentic payments. The title of the next talk is going to be AI and crypto, volatility versus risk. And please put your hands together. This is going to be great for Jacob Lindberg, Chief Revenue Officer at Valour.
Volatility is not risk. I will spend 10 minutes arguing this point, saying that if you are of the opinion that crypto is too volatile, therefore I cannot invest, you're uneducated, and I would love to educate you. Then I'll spend the second part arguing that AI and crypto work together. AI feeds crypto, and crypto feeds AI. This is my investment thesis. My name is Jacob. I'm the Chief Revenue Officer of Valour, an issuer of exchange-traded products. And whenever you talk about serious topics, you need serious legal disclaimers. So please read this, and once you have read it, we can proceed. I'll spend some time now busting the volatility myth and rethinking risk as a rational institutional investor. And educate those who say that Bitcoin is too volatile, or any crypto for that matter. First, we need to look at what volatility is. What is the definition? Well, volatility is the square root of variance, and I would like to call your attention to this area where we have the return of the individual asset minus its average return squared. So we're really looking at how far away we are from the average. And this is, to me, not risk. It's a measure of deviation. Volatility is the square root of variance. And here I have a table of the volatility of stocks in the S&P 500. And what we can see is, if we look back to 2025, many stocks are very volatile. In fact, 174 of them are more volatile than Bitcoin. And 16 of them are more volatile than ETH, as measured in 2025. So we have a bunch of names here, famous ones like Tesla, Palantir, and others. So the range is 62% to 110%. So if you own stocks, you might as well own crypto as well. At least if you think it's too volatile. And then NVIDIA and Meta are more volatile than Bitcoin. And this does not hinder people from investing a lot in NVIDIA or Meta. In fact, Bitcoin's volatility is approximately the same as Amazon. So now I've looked at individual assets and concluded that this is not an argument to skip crypto and avoid that in your portfolio. But that's the most important thing. The most important word is the portfolio word. No serious investor cares about an individual asset. We evaluate portfolios as a whole. So then we need to study the definition of portfolio volatility, which is the weight vector times the covariance matrix times the vector again to get the portfolio variance. Or if we write it in double summation form, it's this equation right here. And I'd like to call your attention to rho, which is correlation. It's a number between -1 and +1. The lower the correlation, the lower the portfolio volatility. This is why we care about correlation. In addition, if an asset is too volatile, you can just reduce the weight, because when W goes down, sigma goes down as well. So let's look at some correlations. Here's the correlation matrix for top 10 assets, Bitcoin, ETH, XRP, BNB, and we can see that it's hovering around 0.5. Let's look at Solana row, for example. It's 0.8 versus Bitcoin and ETH and XRP, and 0.66 versus BNB. So if you have a portfolio of only Bitcoin, it's more diversified when you add Solana, and the reason is the correlation. That's the driver of the lower volatility. Here's the stock market. Looking at Alphabet versus Apple, 0.5, Alphabet versus Microsoft, 0.4. Again, a lower correlation implies a lower portfolio volatility. So if you buy the argument that we put a bunch of stocks into an index like the S&P 500 because we want diversification, since the correlation is low, then you have to accept the conclusion that we can do the same for crypto. The last correlation matrix is this one. What I like is the color scheme. We have different asset classes, Bitcoin, ETH, gold, S&P 500, bond market, and the correlations are very low. This is a main argument to include crypto in your portfolio. If you have a broad, diversified portfolio, adding crypto reduces the risk thanks to the correlation. I should say reduces the volatility thanks to the correlation, because personally I think there are better risk measures than volatility, such as drawdowns, downside volatility, and the left tail of the distribution. Now that we understand volatility, now that we understand correlation, let's see what happens when you put a little bit of crypto into a traditional portfolio. So here I have plotted a 60-40 stocks and bonds portfolio, and this is the equity line that you see. In addition, I have added a 4% allocation to VDAP10, the Valour digital asset basket, containing the 10 largest crypto assets. It's a little bit tilted towards altcoins because we have a cap of 30%. So Bitcoin has a 30% weight, ETH has a 30% weight, and then we take from the rich and give to the poor. So it's the crypto market with a tilt towards altcoins. What happens to the risk? What happens to the returns of such a portfolio? The baseline, and here I'm looking at data going back to several years. The baseline portfolio has a return of 14 and a volatility of 10.4. And when I add 4% of the top 10 index, the return jumps 1 percentage point from 14 to 15, and volatility goes from 10.4 to 11.1. The risk-adjusted return, as measured by Sharpe or Sortino, goes up. So Sharpe ratio 0.89 goes to 0.93. And Sharpe ratio is the return divided by the risk. And the max drawdown doesn't change that much, from 11.3% to 12.6%. So you get a better risk-adjusted return if you add a little bit of crypto to your portfolio. If you're a passive investor, you should have something like 2.2% of your portfolio in crypto. And because I am more bullish on crypto than most people, I think a 4% allocation is suitable for me in this simulation. But even if you were at just 2%, you also increase the Sharpe ratio from 1.12 to 1.19. So adding crypto to your portfolio is a good idea because it has good historical performance and it doesn't contribute that much to the portfolio risk thanks to the sizing, so you can weigh it appropriately, and thanks to the low correlation. That was all historical data. So what about the future? This is an investment thesis under construction, a few weeks into my job, so feedback is welcome. And I'll talk about 3 different assets, Bitcoin, ETH, and the dollar. I'll argue that crypto impacts AI positively, and AI impacts crypto positively. First, Bitcoin. AI agents will pay each other. I think we can take that as a given. In order to produce work between each other, they'll pay each other. The question is, how will they pay each other? Will they use banking rails? What will they use? To me, it's fairly obvious that Bitcoin is the currency of choice for AI agents. It's censorship resistant, so if they do make a payment, they can be sure that it will arrive in approximately 10 minutes. And they can also be sure that no human will intervene. And this is critical. And Bitcoin is the only asset that exhibit these properties. So Bitcoin will be used among AI agents to pay each other for work that is done. The question now is, how does that impact the Bitcoin price? Well, more transactions lead to a better use case, so it is positive for Bitcoin as a payment system. But if you want to think about this in terms of valuation model, you can think that the global GDP multiplied by the AI share of the economy times some historical multiple of market cap to daily transaction volume results in this numerical example, a $60,000 addition to the Bitcoin price. I don't think this is properly priced in, but once it is, and once we see AI agents paying each other autonomously, then some of this might be priced into the market. So this leads to the conclusion by Bitcoin. The second asset I want to talk about is ETH. And the limited liability company is a fantastic invention. It allows us to share risk, pool capital, deploy that capital, produce goods and services. It's a magical innovation, but it only works for humans. Because ultimately, what backs up these contracts between people is the threat of violence or violence itself. And this is completely ineffective against AI agents. They cannot go to prison. So if they break a contract, nothing happens. The entire legal system is completely ineffective towards an AI agent. So we need something else. There is a clear need for a legal wrapper for AIs. Even if two AI agents agree, if we don't have some smart contract or something that can bind them or prove that this agreement exists, we cannot really trust their economic activity or their economic output. And the solution is the DAO, the Decentralized Autonomous Organization. It is a perfect legal wrapper for AIs to raise external capital, pool risk, deploy that capital, and I think they can do this without a company registration or some human putting some paper from one basket to another. So it is native to the internet. And the result is that once AIs can collaborate with each other in a DAO structure, just like humans can collaborate in a company, we will see increased economic activity. We will see humans or AI agents deploying capital to these decentralized autonomous organizations because they work. They're able to achieve their goals. Again, we need to think about the price driver, not just that this is good for a certain use case, therefore price should go up. How will the price go up exactly? So here we see that if AI agents deploy smart contracts, the gas fees must be paid in ETH, which increases the demand, and then ETH are burned from the supply, which drives the price up. And this is a deflationary mechanism in EIP 1559. And it burns the base fee. And this is what drives the ETH price up When supply goes down, price usually goes up, especially if it's useful in a lot of economic activity. The third asset I want to talk about is the dollar. So we talked about Bitcoin, ETH, and now the USD. AI leads to unemployment, which in turn leads to money printing. The way AI leads to unemployment is that it displaces knowledge workers. It doesn't displace people with the lowest income, which technology often does. This particular technology displaces the people with median income or above average incomes. And this will have a ripple effect of the economy because these are the people who consume, these are the people who own houses with mortgages. And so a technological revolution that means that the masses are unemployed is vastly different from a technology that we have seen in the past. So if AI displaces knowledge workers, we will see consumer credit defaults and mortgage defaults, and this leads to a banking crisis. What happens in a banking crisis? The Fed will print money. That's what they usually do. That's what they did in March 2023 in the SVB collapse. It's their action of choice. So that's on the one column. Besides this, we have another mechanism going on, which is the fiscal channel. So if AI displaces knowledge workers, and if you're not convinced of this yet, just look at what happens at the companies that Elon Musk have and Jack Dorsey. So AI leads to unemployment, and this creates less tax revenues in addition to more unemployment benefits. This grows the US deficit, which wouldn't be a problem if it wasn't for the fact that the deficit is already astronomically large. So you have a huge US deficit that keeps growing, and this is one of the drivers for the growth of the US deficit. And as Ray Dalio has argued in multiple books, if you look historically, what happens when the deficit gets too large? The only way out is to inflate. The only way out is to reduce the value of that massive debt burden with inflation. There's no other politically acceptable means to end such a high debt burden. So we have these two different channels, the banking crisis and the fiscal, and both of them lead to money printing. And when you print USD, that drives crypto prices up. My second slide on the dollar is a little bit different. Here, I'm arguing that whenever we have a war, we see rate cuts. And every US president since 1985 has engaged militarily in the Middle East. And every single time, they cut rates. We saw this in the Gulf War, September 11, Iraq, Libya, Syria, Yemen, Iran. So this has happened in the past. I think they will cut rates today as well. So we see massive spending on war, massive spending on AI. Whoever has the best AI is well poised to win the war. So now it's just not spending money on weapons, it's also spending money on AI in order to win the war. And when they cut rates, this is a positive price catalyst for hard cap assets like Bitcoin, gold, bunkers, and my argument here is that the lower rates drives up crypto prices. So in summary, unemployment and war increases deficits further, leading to money printing and rate cuts. Okay, that's the thesis. That's the investment thesis. How do you invest in it? There are a bunch of ways you can do it. Valour is offering regulated exchange-traded products tracking the price of both individual assets and basket products like the top 10 index that we saw in previous slides. Here, you have a selection of AI tokens and decentralized exchange tokens, because AI agents will probably trade on a decentralized exchange and not a centralized one. So we have BitTensor, we have Fetch, we have Virtuals protocol in the AI token category. So BitTensor is a decentralized marketplace for AI ML models. Fetch is an autonomous AI agent network. Virtual is an on-chain AI agent launchpad on Base. And you can go up and read more on these projects. And Valour's revenue model is a fee on assets under management. And the DEX tokens are the Graph, Uniswap, Curve, and Hyperliquid. Personally, I'm most bullish on Hyperliquid of these. They have 100+ million revenue per employee. You can trade macro events on the weekend. And there are some strong network effects when it comes to liquidity. So I think you should bet on a winning horse. And lastly, another core position you could do is DeFi Technologies, the parent of Valour. And I asked AI, is DeFi Technologies undervalued? It said that DeFi Technologies looks significantly undervalued right now. This is Claude. Just highlighting some numbers here. Book value 150 mil, market cap 299 million, cash on balance sheet 114. This means that the market is valuing the company as $185 million. But last year, 99 million in revenue. So the multiple there is 1.85x for a company with more than 200% growth in revenues. So that's the investment case for that, and the investment case for AI and crypto. Again, my name is Jacob. Thank you so much for listening.
Welcome to Signal Week.